Hello, welcome to AleaSoft webinar. My name is Alejandro Delgado, Technical Director of AleaSoft and Associate Partner of Alea Green, and thank you for joining us today in this webinar with the topic Energy Markets Amid the Gas Supply Crisis. Our first speaker today will be Oriol Saltó, Data Analysis and Modeling Director of AleaSoft and Associate Partner of Alea Green, that will analyze the evolution of the European energy markets. Then, we have several speakers from Deloitte, sharing this session with us for the third consecutive year, and that we talk about the financing of renewable energy projects and the importance of price forecasting in audits and portfolio valuation. They are Álvaro Antón, Director of Financial Advisory, Ricardo Benito, also Director of Financial Advisory, and Luis Garcia, Manager of Global IFRS and Offering Services. If you have any questions at any time during the webinar, please use the Q&A menu and we will answer them after the presentations. And now, I hope you enjoy the webinar. Oriol, please share your slides.
Thank you, Alejandro. Good morning, everybody. Well, we are already in the winter that we were all fearing, and well, it started not quite as we were expecting, but we are sure it is full of surprises. So let's start right away. As always, I will start with a few words about AleaSoft, in case you don't know us. In AleaSoft, we offer forecasting services covering all the energy markets in Europe, and now also starting to cover energy markets in North America and South America. And our goal is to, and our challenge is to cover energy markets at the global level. We forecast obviously demand and price of the energy markets, but also any variable, any factor that can have impact on those markets. So renewable energy production, weather conditions, socioeconomic indexes, CO2 prices, oil, gas prices, etc. And not only day-ahead markets, but also futures markets or ancillary service, like intraday markets, etc. And we are also offering hourly price simulations up to 3-5 years into the horizon. Very useful in case you need them as an input for model risk analysis, for instance. And the methodology that we use for forecasting, it's our own technology developed by ourselves specifically for forecasting on the energy sector. And the three main points that we always like to stress about our methodology is that it is a completely scientifically based methodology. So that makes the results reliable and coherent from delivery to delivery. And well, we have been using it now for more than 23 years already, starting in the Iberian electricity market, and now we're covering, as I mentioned, all the energy markets in Europe. So I always like to start showing this historical perspective of the oil price. Oil price is kind of this index about the global economy, so how the global economy is going. And basically, we reached prices already, prices, historically high prices, close to, well, not historically high prices, but very close to the highest prices that we had in 2008. And if we make a zoom in the last month, in the last weeks, when we had our last webinar, it was 5 weeks ago, we were in the middle of this downward trend. So basically, there were a lot of fear about the slowing down of the global economy. So basically, oil prices, because demand was expected to decrease, so oil prices were going in this clear downward trend. Since the announcement by the producing countries that they will start cutting the production, they get to stop this declining this downward trend, and now prices are around but below the $100 per barrel. And what is interesting is in in gas prices, because as I mentioned, we are already in the winter. We were all fearing the winter due to the possible problems on supply, but as the winter started with very mild temperatures and the stock levels, the reserve for the gas in all the European countries are really full. They are above 90%, 95% in most of the countries. So let's say the situation is quite ideal. So prices have been clearly decreasing. Right now we are back to the prices that we had in the last quarter of 2021, last year. So basically we are getting to the levels that we had just when this gas prices crisis just started. So let's see. But as you can see, we have been we have had sharp decreases of gas prices several times during this crisis. So for sure, we cannot rule out new peak prices during the winter, depending on weather conditions, depending on how far we consume the stocks and the reserves, how the supply can be disrupted. So we cannot rule out anything. We cannot say that the crisis is already gone, because winter can still be quite complicated and quite difficult. On the other hand, CO2 emission rights prices are very calm after reaching the highest prices in just after just before our last webinar. Basically, we said at that time, well, maybe we are seeing an increased volatility after quite a stable period, but what we have seen is that basically we have changed the level of the prices. Now we are around 60, 70 euros per ton, and basically even the volatility has been noticeably reduced. Now, about electricity prices, I will not have time to go over each individual market, but as always, I will take this opportunity to show you about our online data platform, where you have all the electricity markets, or the main electricity markets in Europe. You also have fuels prices, so gas, Brent, CO2, etc. Also electric power futures, and also macroeconomic data. And for each market, you have all the most relevant variables that from that market. And we are continuously adding new data and new markets. So and now this month of October we have a promotion, so it can be a good opportunity to have your account in this online data platform. And I'll take this opportunity to show some kind of analysis that you can do in this platform. Basically, you can show data, download data, work a little bit with data, and also do some kind of analysis. For instance, let's say something interesting that will happen this year. So probably we are reaching the end of the year, and probably when we get to the end or very close to the end of the year, there will start appearing news pieces about how the captured price for the photovoltaics in Spain this year is going to be very low. So our forecast show that the capture rate for 2022 for the photovoltaics in Spain is going to be around 88%. So a discount from the average market price around 12%. That's quite a lot, because just before 2019, it was already above market price, and right now we are we are forecasting a discount of 12%. So it's quite important. But it's so probably some people will say, this is price cannibalization. This is going to get worse and worse with in the following years. But what I will show you is how you must understand that this is 2022 and also 2021 and 2020 are are anomalies in this situation, and I'll show you why. So if I put in a graph the price and the photovoltaic production, I'll put it in a monthly for the whole year, so since January. Basically, what you can see in blue is the price. So we had the highest price in the history of the Iberian market in March, and since then, in mid-June, we had this price cap on gas prices for the Iberian exception. So basically, prices have been very stable since June. And if you look at the photovoltaic production, that it's in red, basically you can see how when the prices were higher, you had very low photovoltaic production. This basically because it was during the winter. Even March was exceptionally low because it's usually higher, the solar production in March. So when we had the highest prices, we had an exceptionally low photovoltaic production. And basically most of your production during the summers is, or it was when the prices were going down. So at the annual level, we are having most of our productions when prices are lower. This means that the capture rate for the photovoltaics is going to be quite low. As I mentioned, it's going to be around 12% lower than the market price. But it is an anomaly. It's this 12% of captured rate, it's not due to the penetration of the photovoltaics. Part of it is, but most of it, it's due to how the gas prices in this case has driven the electricity prices and how volatile has been the market price during this year. And something similar happened in 2021. We can go show another year. 2021, something similar happened. So the lowest prices were when we had most of our solar production, and then when prices started getting higher, so the real crisis started, then it was when the photovoltaic production was already going down for the winter. So also in 2021, where the discount rate was around 6-7%, I think, something like that. Also was an exceptional day, was an anomaly. So if in 2023 things are going as expected, we are forecasting a discount rate from the market price around, if I'm not mistaken, 4-5% probably. And it doesn't mean that we are not getting enough photovoltaics. It doesn't mean that photovoltaic is not pressuring the prices down. It just means that we are getting back to our to the normal path of the prices and the price cannibalization. So just an example of something that you can do with this online platform. And in our website, you can find all kinds of reports that we make about energy markets and anything that has an impact or related to these energy markets. So the monthly average electricity market prices for the main markets in Europe. Basically from in September, that is the last whole month that we have, compared to August, that was the last complete month that we had in our last webinar, we have had a decrease of 24% on average on electricity markets. This is because well, basically related to the decrease in gas prices that we have just seen. The market that is behaving differently of the rest is the Iberian market, because we have in place a cap on gas prices and the gas used in electricity generation. And in this case, the decrease it's been lower because prices were already very low. And looking at the last days, where the last month on a daily price basis, we are seeing how during the peak on gas prices by the end of August, we had the highest prices in most of energy markets. The prices in the Iberian market very stable due to the cap on the gas prices. And an interesting thing that has happened just yesterday. So the price cap on the Iberian market is at 40 euros megawatt hour of gas, and gas prices has went below that. So basically, this gas price, this price cap does not apply. So gas power plants are not being compensated, but because of the congestion rents with France, where we are exporting a lot of energy, these congestion rents are used to decrease the compensation that we need to pay to the gas power plants. Even if we don't have to compensate the gas power plants, then we are having a discount on market price already. So it is a particular situation that has occurred the last 2 days. So basically, the price that the consumers has to pay is already lower than the market price when it's usually the other way around. So, and looking now at the power at the power curves, at the forward curves for the commodities, CO2 and electricity, just to see what the market agents are seeing right now about the future. We are comparing the forward curves with the ones that we saw during our last webinar, so 5 weeks ago. For Brent oil, no major changes. So basically, this means that prices, spot prices, are going more or less on the path that it was expected. Very different situation on the gas futures. So basically, as the spot prices decreased so sharply, so importantly on the short term, we are seeing this very important decrease. So 29% on the futures for the winter, 21% if we take the whole 2023. But an interesting thing is that this decrease that we see, it's only in 2023, basically. So practically no changes from 2024 on. So basically, the impact that this has on our forecasting prices for electricity markets, basically we are seeing a reduction on the forecast price for 2023, but the recovery to these equilibrium prices at the long term are not accelerated. So even we are seeing lower prices in the short and medium term, we are not seeing a faster return to the normality, let's say, at the long term. So again, these historical levels are not expected before 2026, 2027, so something similar that we are seeing in the electricity markets. And in the CO2 forward curve, as in the case of the oil, basically no changes. The spot prices for CO2 are very stable, so basically no changes in the forward curve. And in the forward curves for electricity markets, basically no changes in the long term, and interesting changes in 2023, following, as we have seen, the changes in the forward prices for the gas. So basically, Italy and Germany are showing a decrease in Cal 23, following, as I said, the decrease in futures for gas, but no changes for in Spain, mainly because nearly half of the year we will have in place still the price cap on the gas, so much lower influence of the gas prices. And then we have France with basically no changes. And France, it has its own problems with the nuclear energy. They are starting, so the recovery of the nuclear power for the winter, it's getting delayed. It's still not out of time, but it's getting complicated. So the situation is quite different in France, and that's why we don't see changes in Cal 23. And just to end, looking for what are the key elements when forecasting electricity markets, also as a summary of what we have seen. So the European Commission has approved a cap on the revenues received by the technologies that are not using gas, let's say, basically trying to cut the what are called the windfall profit, something similar to what we have in Spain. And the maximum cap has been set at 180 euros megawatt hour, but this is the maximum. Each country has to apply it in its own way with its own price cap. And well, this, let's see, maybe Deloitte, our next speakers will talk a little about that. This is somehow going to impact on PPAs, because PPAs that are about to start, well, they were expecting some revenues if they had part on merchant that they are not going to receive right now, and so we are going to see probably some effects of these new rules in the PPAs that are being discussed right now. Well, the beginning of the winter, it's been quite better than we expected, but as I said, we will have future surprises for sure during the winter, but at least the beginning has been quite quiet. And when looking at the midterm, we see a decrease right now in 2023, but the recovery to the long-term prices still around 2026, 2027. And at the longer term, basically, we are not seeing much changes. So things are still more or less as we were seeing a few weeks ago. And just let me finish inviting you to our next webinar. It's going to be November 24th, and we will have Soto Solar talking about financing, PPAs, merchant projects, and all this. So thank you, Alejandro.
Thank you very much, Oriol. And thank you, Álvaro, Ricardo, and Luis for sharing once again this webinar with us. And Álvaro, when you're ready, please, you can share your slides now.
Yeah, sure, absolutely. So let me share the screen. So I understand that now the presentation is available.
Yes, we can see it now.
Okay, that's great. Okay, thank you very much. Just following with the previous webinars that we have done in the last 2 years, this is the third one where, well, basically we talk about the financing and how it's impacting the current situation into the financing. Like we did in previous webinars, we are showing this first slide is we are trying to show what is the standard life cycle of renewables, and it's important for you to know that Deloitte has present in every single step of the life cycle of the renewables, starting from the permitting engineering and as well going through the financing at ready to build or COD. As well, we are covering construction operation with our due diligence colleagues, and as well, obviously with the audits and prepare of capital market readiness and going public of the SPVs or the platforms of renewables. So this is just a reminder that Deloitte is having a holistic approach to the renewable business. And then after that, I think we can go straight away to what we have on renewables and financing in Spain. At this moment, well, what we know is, and everybody knows, is energy transition is happening, and basically this is a consequence of the evolution of the renewable technologies for the last 20 years or more than that, where they have been able to reach grid parity, which means that they do not need any subsidy. Therefore, the feed-in tariff that was placed during the early 2000s now is no longer applicable, and this makes the renewable energy to be very competitive versus the other technologies. This as well, when you put together with the need of decarbonization, renewables is one of the main solutions to help on this decarbonization. Therefore, there is ambitious targets for the European Union to reach certain level of renewables for 2030, and basically for Spain, this has been formalized under the PNIEC. Which means that for 2030, we need to have around an extra 50 gigawatts, which means a very large investment, which will be around 35 billion euros. So that is, those are very large numbers to cope with. Addition to that, nowadays, as has been mentioned by AleaSoft, everybody knows that there is some uncertainty on the electricity pricing. Basically, if we see for the previous 20-30 years, the trend has been growing on a very steady basis within the levels of from 20 to 60 euros per megawatt. But now in 2021, we started to have this large increase, basically due to the cost of gas, now the uncertainty of the war, and uncertainty of the supply chain, inflation. All of that is making that this is a quick overview how it is in this current uncertainty. And when we say the market advisor, we are taking an average of the market of the information of the market advisor, so it's sort of a consensus what we see is during 2023 pricing are boosting to the levels depending on the scenario, but we have from 180 to the 300s, and then thereafter a soft decline and trying to reach more adequate levels for 2030. That's important for the financing, and now we will speak a little bit on that thereafter. With this slide is quite interesting how the market advisors has been behaving to the movements of the projections and to the reaction of the news on the electricity market. What we see here is for the same period from 2022 to 2040 is the different projections of the price has been produced in the reports. Typically, market advisors, they produce a quarterly report. So we are starting for the first quarter of 2021, where we see the trend for both the low prices and the high and the central prices. They were very more or less aligned. But whilst we were going through the third quarter of 2021 to the year 2022, market advisors has been increasing quite a lot their projections of the pricing of the electricity in all scenarios, in the low scenario and as well on the central. But what we see is all of them they converge in 2030 into the levels of 30 to 40 euros per megawatt for the lowest scenario, and within the 50 and the 60s for the central scenario. So what we see here is this current uncertainty is expected to last until 2030, where everybody thinks that everything will be more or less normalized. So that's important, that the current situation is something that nobody's projecting to be constant during the years, and it's something that will be temporary. Having said that, and coming back to the need of those additional 50 megawatts and the very large investments, in order to cope with that, what we need to have is a good resource, a good renewable resource, technology, good policies, which means support from the European Union and the regulation at the different levels of each country, which we have, and as well we need to have money, which means sponsors willing to invest into this type of infrastructure, and as well lenders to help on financing and to make profitable and leveraging the projects for the sponsors. And all of that we have all of that right now. The thing is that in view of this grid parity, now a new element has been taken into the a new element has been taken into the picture, which is the merchant risk, where basically lenders and sponsors, they will try to take a view, and that is the importance of the projections of the electricity prices that we have seen in the previous slides. In relation to the financing, typically these transactions, they are financed on a limited recourse long-term lending, which means project finance, standard project finance. This is something pretty known to the lenders, pretty known to the sponsors, where typically lenders, they will analyze the different KPIs of the transaction, which means capex, opex, tax assumption. Most of this is standard work for a project finance. So typically this has been validated by the due diligence advisors for the lenders. So nothing new on that. Lenders, they have their own frameworks for this type of transactions, which are very well known to the market, and which means, you know, typically is construction plus 16 or 18 years of repayment period. So that gives you an idea how could be the debt sizing. Debt sizing typically lenders will do on a conservative scenario of the P90 scenario rather than P50 of production, but that's pretty standard. And then what they need to do as well is to manage lenders. They need to manage the merchant risk, which means that they will try to mitigate that using the curves from the market advisors. Typically, they use the low projections, and as well another way to mitigate that is the using of PPAs. And the using of PPAs, which as we'll see in the next slides, PPAs is an instrument which is necessary to have bankable deals. However, it is clear that PPAs is destroying value to the sponsor, because obviously they will need to mitigate the merchant risk, and therefore on that process they will be capturing a lot of value rather than leaving the value on the SPV on the project. But you know, everybody knows that that's a way of mitigating the merchant risk, and it is pretty much accepted, the presence of PPAs in the transactions. Therefore, this brings us a couple of structures for project finance, which is the pure merchant project finance, where this is ideal. However, the reality is that the market is not very depth on this structure. We have just a few lenders able to do pure merchant risk, and typically they will be using a very conservative debt sizing assumptions, and the reality is that the availability of funding in the market to cope with these transactions will recommend to have a projects no bigger than 100 and 150. Will say that is quite a big number, but typically projects of 50 to 100 or a little bit more than 100 megawatts will be ideal for merchant risk, because that will require only 2-3 banks, no more than that, and precisely that will be the banks available to finance this type of merchant risk. Then we have on the other side, we have how the lenders, the whole commercial lenders and multilateral institutions as well has been available to finance this type of transaction using the PPA, what we mentioned before. So the only thing here that is remarkable is when we face transactions for more than 300 megawatts, then this is starting to be a little bit challenging because PPAs for more than 300 or 400 megawatts it will be difficult to have in one single off-taker, and to have one transaction with different off-takers is a quite. It's a bit complex transaction, so ideally is to have just one off-taker. But well, in any case, this is the way that I would say more than 80%, 85% of the transactions has been closed. So using the PPA as a clear mitigation of the merchant risk. Okay, so now. In this slide, we are trying to show which are the available PPA market structures which are considered bankable. Obviously, the PPA world is never ending. I mean, you can do whatever you want. There is a lot of structures of takers. They are very, very creative, but the reality is when you face a project finance, lenders, they will need to stick to simplicity, and what we see is lenders will be happy to absorb transactions with a swap or floor, or a combination of both. The question here is the swaps. Typically, they increase the leverage of the transaction. However, as we mentioned before, the PPAs destroy value for the sponsor, and the swap is just the case. So typically IRRs for transactions with a pure swap, they will be lower because part of the value of the transaction is being transferred to the off-taker. Then for the floors as well, lenders are happy with floors. Floors makes available a more profitable transaction for the sponsors. However, typically the leverage trying to decrease, as lenders will try to have the view of the price up to the floor that will be considered as contracted, and anything above that will be considered as merchant. So with different debt service cover ratio, obviously for the merchant will be higher, which will mean at the end that less debt will be raised. However, depending for the sponsor on the level of pricing that the sponsor is believing they will be obtaining, there is much more upside, because floor will provide all the upside from the strike of the floor to the price that the sponsor is believing they will take. So these structures as well works well for the sponsors, and as well works well for the lenders. And then a combination of both swap and floor. Typically, what we see in the market is, let's say, the first 3 years or 4 years under a swap, and then the remaining under a floor. And typically lenders will be requesting PPAs for around 10 years. So for those PPAs that we have from 1 to 5 years, okay, there is a lot of liquidity, but those are not very bankable, to be honest. It's fine for the sponsors to mitigate partially the merchant risk for the sponsor, but it's not very practical for project financing. Then for those from 5 to 12 to 10 years, the liquidity on those PPAs are declining a little bit. This is more a bankable situation. And then for those PPAs that they are above 10 years, I mean, they are not that very common on project financing, because it is not necessary, as lenders will be very happy to take PPAs from 9 to 10 years, and anything beyond that will be a merchant, and that will provide a lot of upside for the sponsor to increase or to boost the profitability of the transaction. So here as well, we have indicated just some views of the pricing. Obviously, this is changing every day, depending on how is the spot, how is the OMIP forwards, and how is the macroeconomic and geopolitical situation. But what we see is for swaps now, we are seeing from 50 to 60 euros per megawatt for a 10-year. For floors, the strike that typically I've been using is around 30 euros per megawatt, and then here the key question is how much is going to be the premium. Premiums, we see premiums from 6 to 10 euros per megawatt. Something interesting that we have seen in the market is mid last year, it was very difficult to find off-takers accepting to provide capture prices. Now we think that has changed. Now we are seeing off-takers more happy to provide or to quote pricing on a capture basis. Therefore, this is ideal because the capture rate risk will be partially taken by the PPA during the PPA period, and that is ideal for the lenders. In any case, lenders as well, they accept some sort of base load on the PPA period, but they will take some mechanism to try to mitigate this potential risk of movements on the capture price. Then we move forward to the next slide, where we have tried to recreate and to show on how is behaving in terms of financing and in terms of IRR these two situations of merchant risk and PPA risk on the financings. And for that, what we have chosen these assumptions. They are pretty general, to be honest. Obviously this may change depending on the different circumstances of the project. But what we can say here is, in the last half year or in the last year, we've seen that the level of the capex has been increased quite a lot compared to the previous years. Previously, we used to see levels of 600 euros per megawatt or even less, and for the development fees, more in the region of the 100, 120. Now we are seeing that in the market this pricing is increasing. Basically, the development fees, because of the market is there. There is a lack of ready-to-build transactions due to the licensing processes, but that is a subject of another webinar, and as well on the capex. Obviously this has been increased due to the inflation, due to the supply chain problems of that we have been suffering, the cost of the transport of the panels in case of solar, which are coming from China. So there is different reasons why these metrics has been increasing for the last months, which, you know, for the lenders is not a problem as soon as they are validated by the technical advisors. So that is not an issue, but I think it's remarkable to mention that this has increased for the last months. And as well, here we are using the typical debt sizing assumptions for both merchant risk and with financing with PPAs. where basically for debt tenors, we are using COD plus 18 years for those transactions that has a PPA, a 10-year PPA, and COD plus 16 years for those transactions that they are on a pure merchant basis. As I mentioned before, when lenders will try to dimension on a P90, that's for sure, and the debt service coverage for contracted cash flows, which means those cash flows or those revenues that they are coming from the PPA, they will be requiring debt service coverage of around 115, whilst for merchant they will be requiring 145. So this is the key driver why merchant exposure will leverage less the transaction, and as well the other metrics that lenders would like to see is for those transactions that has PPA, they will be able to leverage the transaction with a debt to equity ratio of 75%, even 80. But when they are talking about merchant risk, they will be in the region of 50, 55. Some banks they are going as well to 60%. So that gives you an idea what would be the difference of the sizing depending if there is a PPA or if there is not a PPA. Okay, so here in this slide, what we have tried to show, to display is in this line we have the different productions, level of production in a net equivalent hours. We are starting from 1,700 to those to the very best solar transaction in Spain to 2,100, and these are the levels on a flat basis. So we chosen these flat levels because it's easier with that to see how the IRR of the project is impacting or is moving. So we are moving from a flat price, a nominal capture price of from 50 to 80 on a flat basis, and as well. Here is the level of debt. The debt, as we mentioned before, this is based on the lowest scenario of the market consensus. So this is not moving. The debt is fixed for the level of pricing. However, is moving depending on the level of production. But this will show you the green areas. Will show you those situations where the IRR, these are the IRR of the transaction, where the IRR is higher than 8%. So what we see here is for those transactions that has at least 1,850 net equivalent hours to 2,000 will be starting to provide IRRs over 8%. Obviously here, the level of pricing where the sponsors are comfortable will be key to determine what will be the expected IRR of the transaction. Therefore, lenders has very clear that the pool price projections will have to be the low ones of the lowest scenario of the advisors. However, the sponsors, they will need to take a view because that will impact quite a lot what could be the IRR of and the profitability of the transaction. So this is on a pure merchant basis, where we see there is a lot of green areas. Now we move to the next one. This is a transaction with a PPA. This PPA. Sorry about that. This is the full merchant. This is the full merchant where we see a lot of areas in green due to the upside of the pool price. Then now we move to the next one, which is a 9-year swap. This is a swap at 55. What we see here is the off-taker is now getting a lot of value, and mostly for capture price because it's a fixed price. So anything above 55% in the curve will be taken by the off-taker. So we are reducing quite a lot the green areas for IRRs above 8%. Now, if we move to a scenario where instead of a 9-year swap, we have a 9-year floor. Now we see more green sections, and that is because the floor will allow to capture all those prices that they are above the strike level, and obviously the strike level will be impacted by the premium, and the premium is something that will be paid yes or yes to the taker. But even paying that premium on adequate levels of the sponsor pricing curve, it will provide a lot of green areas. So which means that this is even better scenario for the profitability, and even though is providing less debt. If we move to the 9-year swap, we see that this level of debt is higher to the net floor, and that is because here in the net floor now we are having is playing the debt service coverage ratio for the merchant revenues compared to the contracted revenues. Therefore, debt is decreasing a little bit, but profitability is increasing because the project is absorbing all the upside of the pricing. And as well, we have here recreated or shown the a mix of 3 years and floor, where we see more or less, well, a little bit less of profitability, and as well the reduction, a little bit reduction on debt. But at the end, this is the ideal situation where we see most of the lenders where they combine the necessity of a PPA and as well taking advantage of a period of floor where they will be capturing the excess of pricing above the strike of the floor. So here we place again the same slide of the projections of prices, and the important thing here is, as I mentioned, is pretty clear for the sponsors to decide what level of pricing they will be comfortable for the incoming years in order to determine the profitability of this transaction. What we see is we have available this white line, which is the MIP. The MIP, as everybody knows, there is difficult to have a strong liquidity for the longer periods, but at least it's giving some sort of indication of the levels in the medium long-term basis. But clear sponsors and lenders will be relying on the projections of the market advisors. The lenders being placed for the debt sizing in the low scenario, sponsors being placed on the green scenario, and those sponsors that they have a very positive views of the projections in the future of the pricing, they will be taking the highest scenario, which, to be honest, I'm not saying that very common. But in any case, at the end, what we have here is once reached the year 2030, projections is becoming more stable and more in line with what we have seen in the historic period for the last 20 years. So in essence, what we have here is renewable transactions is still a profitable business, which implies volatility, and that volatility, there is a ways of mitigation that volatility by means of believing on the taking the view on the projections of the prices, or going into PPAs, which will be securing certain levels of pricing. However, on the contrary, they will be losing value. But in any case, that's a way of mitigating merchant risk, and it's important these renewables transactions to have debt on in order to reduce and to leverage the profitability for the sponsor by reducing the WACC, the weight cost of capital, and as well, as we mentioned, PPAs is is not ideal, but is the solution for banks to mitigate merchant risk, and that will depend very much on the transaction that we are managing. However, taking into account that large transactions clearly will need PPAs because there is no availability of funding in the market for large transaction on a pure merchant basis. But at least the debt will be raised. That is no doubt, because banks, they are eager to place money on these structures. And by the way, renewables is a world where they feel very much comfortable. So what else? What we can say? Yeah, is important as well for the evolution of the renewables, to see the evolution of the future markets, to see the evolution of the auctions, and because that will be clearly mitigating the current circumstances of the merchant risk. But this is something that will be start to see in the incoming months, as we have auctions very soon within this year and next year. So those are the main parameters of the financing and how to tackle this large investment with the collaboration of banks on a long-term basis. So that's the end for me.
Thank you, Alvaro and Luis. You can share your slides now. You are on mute.
Okay, thank you, Alejandro. Okay, well, thank you, Alvaro, for your presentation as well. I will be talking about the risk and difficulties in the preparation of financial information, and also you will be able to see how important it is to have proper projections on electricity prices in the future, and how this could be also applying and involving in the valuations of possible derivatives that may be happening with a contract of PPA. So first of all, to have an overall idea of what we see in the market for financial information, you have from local players to international groups playing at different leagues, but also with the same rules. And here we have the main spectators, which are investors, banks, and regulators for each country, which could be also having different considerations. And then the key question is, what do they expect? So there are different aspects of that these main expectors can expect. For example, risk exposure, which is a main key aspect that could be also affecting the derivatives or the PPAs, investment performance, regulatory compliance, which, as you know, there are updates on regulatory compliance each year or constantly throughout the year. Business performance, here looking at accounting, in the P&L, there's always lots of volatility if you don't have a PPA properly contracted. So this is also something that companies need to consider. And transparency, for example, in the disclosures that given the rise of electricity prices, there have been more and more necessity to show what the impacts have been on the balance sheet and P&L for the companies. So as you know, accounting now, as I have mentioned, is critical, and reliability is more than worthy. Okay, so now back to the friendly accounting books. On a power purchase agreement, there are different features that you will have to consider when you're contracting this power purchase agreement, or when you have to measure the valuation or possible impacts on your financial statements. These are quantity, maturity, delivery, the price, the settlement, if it's settled by differences or if it's a physical settlement. And then you would have to look at what possible accounting standards could apply in these contracts. There is a decision tree normally considered, so there could be IFRS 15 implications over executory contracts, IFRIC 12 considerations over concession agreements. There could also be a lease under IFRS 16 on the property for the electricity producer. And then if none of these apply, then there most likely could be a derivative within the contracts. What I haven't mentioned is that even though you may find a lease or a concession agreement or executory contract within these PPAs, there could also be an embedded derivative within some of the clauses that some companies may not notice, but it's also important to take a look at these small clauses that people ignore more because, for example, an early termination clause could involve having an embedded derivative, and this has an impact on the balance sheet and probably on the P&L. So now taking a closer look at possible impacts on the financials. So for the first three that I have talked about, IFRS 15, IFRIC 12, and IFRS 16, there could be, depending on if you're a producer or the off-taker, there could be impacts on revenue, on the P&L, which would involve also impacts on trade receivables, on balance sheet, operational expenses for the off-taker and the P&L, and trade payables. This could also have for example, trade receivables, impairment loss, reversals, and then embedded on the certain class of assets in the balance sheet. Then for the derivatives, there's going to be a fair value variation, gain and loss in the P&L. And on the balance sheet, there will be an impact either on assets or liabilities in the financial statement line item of derivatives. And these variations could also be interpreted as cash flow hedge reserve if you could apply hedge accounting within these PPAs, which is also something that I'll talk more in depth in future slides, and which I think is one of the key areas that companies need to take a closer look at, since this has been something ongoing that has been difficult to try to cover if you could apply hedge accounting for the cash flows. Then on the disclosures, on the P&L, you would have to disclose notes on revenues and costs. And on the balance sheet, you would disclose notes on non-current assets, financial instruments, equity, risk exposure area of the financial statement notes disclosures. So attention to detail is key. Here we have different peers, what each peer looks at, management and stakeholders. So management have different strategies. They look at diversity of hedge contracts, diversity of accounting, treatment, and disclosure. And then the stakeholders look at risk appetite and performance of risk management, access, negotiation capability, execution skills. They look for results in volatility, short-term and long-term communication capacity. So it's not easy to manage, but the effort is there. And it's not easy to look at, but understanding is needed. There should be a proper monitoring here on both sides to close the distance. So accounting estimate challenge. Here, what I wanted to present to you all is where are the nightmares for the companies that we have found. So among others, we have the impairment test, business combination, the derivatives valuations, and to see if the company, if the contract is eligible to be applying hedge accounting, which could be one of the most challenging ones. In the impairment test, some of the nightmares could be the cash flow projections, also having an electricity price curve in the long term that could help to have a proper cash projection, and also the discount rate to be applied projections to the present value. In business combinations, assets and liabilities fair value are key, and the price allocation. And in the derivatives, for example, the cash flow projections are also important if you're talking about electricity derivatives, given that these projections could have a big impact on the fair value of the derivatives. Also, other aspects to consider are the premiums and margins. which are paid at the beginning of the contract, and then the embedded options, which could be also embedded within the contracts, and that some companies overlook, and which could also have the risk that then you haven't considered them on your impacts. For hedge accounting, you want to be able to apply a proper hedge on the leg that you are covering. So the cash flow projection is also, as I mentioned before, important. You also need to be able to see your sources of ineffectiveness, because normally we have seen in companies, and companies what normally do is they have a PPA that does not match completely in some occasions the production that they do, or the consumption if you're the off-taker. And then some of the other nightmares that companies have sometimes are, so these variations on the derivatives, when they apply hedge accounting and go through OCI, the reclassification of the reserve is always something that could be tricky. So here, the things that we need to consider: do we use the same inputs for each of them? We consider that it would be more reliable to use the same inputs for for example, for cash flow projections in the impairment test and in your derivatives. And then, are we consistent in procedures year on year? So normally we need to have a consistency here. If we're using some inputs, let's say in fiscal year 21, for fiscal year 22, the most proper way to do valuations or record accounting treatments would be using the same inputs, not just changing from year to year. So it's a bit common sense is needed in valuation models. Okay, so hedge accounting, complex issues. So as you know, there could be different entities: a solar farm with a 15-year base load at 45 euros a megawatt, a wind farm with 15 years hourly profile with 39 euros megawatt, or for example, it could be a market chain, an off-taker with a 15-year swap at 48 euros plus floor of 25, or automotive manufacturer, or any kind of fabric that also is a high consumer of energy or electricity. So what could impact these contracts? So things that could impact these contracts are price sensitivity, demand sensitivity, the offer sensitivity, or other effects. How do they present variation on the balance sheet and P&L? That's one of the main things that companies need to consider, given that depending on how you apply the PPA compared to the covered leg and your projections, you could find that you could have a source of ineffectiveness. You could have an accounting treatment where you cannot apply hedge accounting and the variations would go directly through P&L. This would have big impacts on your P&L with volatility that companies should try to reduce. So it is very important and very key to look at what prices, what contracts, what kind of instruments you are contracting, also considering the accounting involvement of these. Then also other questions that could be key here is, like, for example, would you use in your projections a yearly average forward curve or an hourly forward curve? So here, many companies that try to do things properly and trying to get a valuation the most closely as possible to the reality use an hourly forward curve, just to defend also that they can apply hedge accounting to see that their cash flows match, and to see that, well, if you, for example, have a solar plant, you're not going to be producing at the same price at 3 a.m. than at 2 p.m., right? So it is important to consider the prices every hour to see if what your production projections are compared to the PPA that you contracted, and to see if these have a close relationship and an economic relationship to apply hedge accounting. This is why they are important. It's difficult to achieve a perfect hedge. So I would recommend to just try to have an analysis where you can actually see if there's going to be sources of ineffectiveness in the future, where you can avoid these ahead of it. And yeah, basically, the hedge accounting is now being something that is very trendy on electricity contracts, basically because previously prices on energy were more stable, or in electricity, and as you know, in the past years, having gone up so much, companies are starting to ask more and more about it, because the impacts are being higher and higher, and regulators are also following this up. So just wanted to flag you that this is something to consider. All right, thank you, Alejandro and Uriol. This would be the hedge accounting part.
Thank you very much, Álvaro and Luis, for that great presentation. And thank you again for sharing this time with us. Unfortunately, we have run out of time, and we have already answered some of the questions in the Q&A section, but we will answer the remaining questions directly by email. And as Uriol mentioned, I invite you to register to our next webinar in November that we will share with Soto Solar. And thank you again, Uriol, Álvaro, and Luis, for your presentations, and the audience for joining. Have a nice day.
Thank you. Bye.
Thank you.